Welcome to It's Personal, Finance Canada. I'm Christine Conway.
And I'm Cameron Conway.
And this podcast is a very personal look at personal finance in Canada. Welcome to It's Personal Finance Canada. I'm Christine Conway here with Cameron Conway. And if you're in BC, Alberta, Saskatchewan, Manitoba, Ontario, or the Yukon, feel free to find us at braunfinancial.com. Today we're going to talk about a subject that everyone loves to hate, and that is insurance. We are going to take you through today why people hate buying insurance, why you actually really do need it, and how it works to solve core problems in your life by offloading some very, very, very important risks.
Yeah, so because of our job, our licensing, and what we do today, we're going to be talking about sort of like the life and health side of insurance. So not so much the car, the house, and all the other types. We're kind of dealing with the ones that impact you directly. And these are the things that have the biggest impact when we do like financial plans and get people set up for retirement and other things.
That's right. So full disclosure, like Cam just said, we are a life and accident and sickness licensed insurance agents. And in a lot of the provinces that we represent, you hear about them at the beginning of the show and at the end of the show every week. And a lot of part of our financial planning typically needs insurance as some type of a solve, some type of a solution. And the reason for this is insurance can so easily fix so many financial problems before they happen by having that coverage in place before the event occurs. So we were kind of joking about it before the show, and we were thinking about insurance as prepaying for a solution so that you're not stuck with a big bill at potentially a very difficult time in your life. And bonus points, you get to keep your own savings and assets intact so that you can continue to work towards and meet other life goals, even if those goals are now changed.
Yeah, at its core, insurance is you spending a little bit of money today because there's a likelihood that something could go wrong down the road.
And that is the nature of life, right? So insurance is really all about offloading that risk. And those are the choices that people have. You can assume the risk yourself and assume the responsibility and live with the implications. And maybe years go by and nothing ever goes wrong. And if that's the case, fantastic for you. But for a lot of us, we get stuck in the crosshairs from time to time in life. And these challenges come up unexpectedly, where one day is a perfectly normal day and then everything is forever changed. We've seen it happen too many times. We've experienced it ourselves. And that's why I personally will forever be on the insurance bandwagon as an active, proactive solution to not only solving some financial planning problems ahead of time, but making sure your lifestyle maintains as it is now, or potentially can even get better, right?
Yeah, so that's kind of like the poster for insurance. Things could go wrong. You spend a little bit of money today, get a nice payout later, something happens. But I think people are so overwhelmed with all the different types of insurance they are forced to get into. It can have a bad reputation. It can have a bad rap. Even when people come into Braun, they're much more interested to talk about investments and growing their retirement and not so much on insurance.
Oh, well, that's right. And it's funny, our process actually starts with cash flow first, then insurance, and then looking at the investments, the goal setting, and the financial planning. So these are things that we feel are absolutely core and fundamental in every single person's plan. And while not everyone will invest with us or want to do the financial planning with us, we encourage every single person that walks through our door to at least try to understand and consider why insurance can be a good solution for them. So let's talk first about why do people hate insurance so much? Why do people not want to buy it, not want to talk about it? I think there's 4 key reasons that kind of jump out in my mind. So I'll go through them now. First off, for me, is we absolutely hate paying for things where we don't see an immediate benefit. We all feel like our dollars are stretched far enough, and insurance is intangible. So it feels like just one more bill, one more place that is demanding your money, but We don't know if or when the benefit will occur. So because of that, mentally, it's kind of a bit of a hurdle from that point of view because you feel like I need my resources now, or I should be saving them for the future and not spending money on insurance. But we'll look at that one in just a minute. Second, we all have this very strong "it won't happen to me" bias. We all seem to think that insurance is for other people. I mean, geez, have you ever found yourself thinking that, Cam?
Yes, younger, but then I've also seen it go wrong. And we've had other clients say they'll never need it, and they did need it. And I've got family members who either had car accidents or just things didn't go the way everything was planned, and it could have actually made a big difference instead of making the finances worse for the family and everyone else. But this is just the immortality syndrome that we kind of have, especially when you're younger, that nothing bad will ever happen. So why should I spend these precious little bits of dollars that I don't want to spend on something that I feel like I'll never need? And I'm not legally required to do so like I have with my car.
Well, exactly. And that's actually our third point. One of the reasons that most of us don't go out and do it ourselves is because of this negative connotation that has come into place when insurance has become mandatory in certain circumstances. So this is a complete circle of thought here that occurs because it is mandatory because people are not doing it, and then people are less likely to want to do it or buy it in other areas because they feel like they have to. So think about your car insurance or like tenants insurance, house insurance, commercial or liability insurance. To do certain things that you want to do, to have certain things and the abilities that they offer to you, drive the car, rent the office space, whatever it might be, in a lot of cases, you have to be able to show proof of insurance. And why is that? Because the unexpected happens often enough to so many people that it has become mandatory not only to protect ourselves and our own assets, but to protect the people around us so that if there is an event, everybody is covered. And I think car insurance is probably the most commonly known or common analogy that's easy to use because you think about it as, well, why is my car insurance not one rate forever? Because things change, because your driving experience, your actual experience on the road, your success rate, or if there's accidents, all of that factors into the price that you'll pay later on because of risk, right? But not having that insurance in place is not even optional because of the frequency of its need, of its usage. So because of all of this, we can cognitively understand that insurance maybe is not something we want to buy, but it certainly has very real aspects of being able to protect us in our day-to-day life.
Yeah, and I think kind of like a bonus reason people don't like insurance is they are worried that they'll put all this money in, they'll have a reason to claim, and they'll get no money out of it. I know this is something that kind of gets developed. This fear really comes more out of like the car insurance side and the property insurance side where they think they're covered and then there's just some sort of technicality and they don't get any money. Like I know someone who had a car accident, went on disability, but didn't get any kind of payout from their auto insurance because concussions weren't covered. And Christine has a family member who was an adjuster for a property. And so we hear a lot of stories and people feel that bite that, I'm going to spend all this money on insurance. I'm going to have a reason to claim and then I'm not going to get any money at the end. So they don't want to do another type of insurance.
Well, absolutely. And that's probably, like you said, Cam, one of the biggest reasons that you just don't trust that the outcome, right? Why would I spend $1 today if I didn't fully understand my product, if I didn't fully understand what I purchased, or if I didn't fully trust the person who sold it to me? And I've had a bad experience because of that. And they point at the contract and you go, well, you didn't tell me. And that can cause all kinds of problems. So understanding who you're buying from, as we'll talk about in a little bit, is so important too, just to make sure not only that they're qualified and that they have that experience, that they have access to the right numbers of product, but that they actually care about letting you fully understand the details of your policy so that you can make a detailed and comprehensive and educated choice. So it's not just about the insurance and buying a product, but it's also about the education that can come with it and understanding how it works and is this a product that's right for me or is it not? And I would say, okay, fourth, This one is one that I hear all the time. I can self-fund this. I can invest my money. I'll get a greater rate of return in the stock market. I want to do it myself. I don't want to buy a product. I don't care about offloading risk. And I would say to this one, if you're right, you're right. But if you're wrong, you can get this very, very wrong. And the most important thing, depending on the type of insurance that we're talking about, whether it's disability, critical illness, even health insurance or life insurance, this is where people have to actively understand what they're using and why they would want to self-fund it versus not. So what helps me in this context is I think about my life as a timeline. So I'm the age I am now. I'm 41 years old. I've got potentially until 65 when I want to retire. And then I've got hopefully a lot more good years ahead of me after then. The risk period for me occurs now before I've had the time to save the money I would need to fully fund something going wrong. And that something going wrong could be sickness. Maybe I can't work due to illness. It could be an accident. Maybe I can't work because I was hurt. It could be something like if I pass prematurely, heaven forbid, my spouse and my kids, are they able to maintain their same standard of living? So insurance is really to protect an immediate need that you don't know if it's going to happen now or 10 years from now or at all in some cases, but it's to protect against something catastrophic. And the people that say to me, I can fund it myself, when I look at their budgets and look at their net worth statement and their finances, they're usually people that don't actually have that capital today to fully fund, say, their working career to age 65, or to fully fund even stepping out of the workforce for 2 years or more to recover from an illness. These are the people that, unless you have that money accessible to you today, in the bank, that risk is not fully covered. So the only logical thing to do is offload that portion of risk when your need is the highest.
Yeah, and this is the main problem that we see a lot. And this is why we kind of take people through like that, our 5-process plan, our 5-step plan. Go back to the very first episode of the year. It kind of covers all that. This is why we do the insurance talk before we do the investment talk or the goal setting retirement talk, because a lot of people, they do not have the money to kind of shore up if something goes wrong. And it's also difficult to do retirement plan for someone to get this nest egg developed. And then something comes up where insurance could have covered. And all of a sudden that retirement nest egg is like fully or partially depleted because of a event that could have been helped with a DI, CI, or even some other types of insurance.
Well, right. And I would say the core of this thinking is that problem that we just discussed, that we don't think it's going to happen to me. I don't think this is going to be a me problem. It's going to be someone else's problem. So if you're thinking about your life as a timeline, and if having that money saved in retirement is valuable to you, or your family maintaining the standard of living that you have currently is valuable to you, covering that risk period now makes so much sense. And using money that would ultimately take away from your goals, whether it's a house goal, buying a home, or even retirement, if you're borrowing from another goal, you haven't really fully covered the risk. It's that borrowing from Peter to pay Paul kind of thing, where you're basically taking from yourself in a different area of life. Because we all deal with the things that happen to us immediately now, right? As it occurs, you have to address it. But we could be talking about something like disability, where the risk period could be not only all your career, but all the education, all of the training, all of the stuff that went into making you as skilled as you are today. And if you don't have enough passive income or other assets that you'd be willing to sell, you're jeopardizing that version of the future that you're working towards today with your savings. And the sad reality is that you could be left with a much lower standard of living.
Yeah, and that's the whole purpose of insurance. You are taking a big chunk of risk out of your own wallet and you're trying to assign it to another company that's going to help pay those bills. So again, if you try and DIY it without insurance and something does come up with a CI or a DI situation, you're not going to bankrupt yourself. You're not going to put yourself in a situation where if you can't work for a few years, you can still pay your bills on a regular basis and without having to completely deplete your savings in the meantime.
Well, yeah. And if your savings rate is really important to you, if you're working towards meaningful goals, think about it as ensuring that ability to continue to save. It's so important to make sure that if life interrupts you, you don't fully stop. You still have the ability built in to be okay and to meet your goals. So let's just pivot for a minute and talk about who doesn't need insurance. And I think that this actually varies by type because depending on someone's age and stage and where they are in their life, what their living situation or family situation looks like, all of these can be factors. So, like from a life insurance point of view, someone who doesn't need life insurance can be someone that maybe has fully taken care of themselves. There's no kids. They don't care about the inheritance. Money's going to go to charity or it's going to go to other family members. When they're gone, that's not a priority for them. They're most concerned with spending what they have now to enhance their experience of life. So they have the willingness to sell hard assets. But that same person who doesn't need life insurance might have another type of insurance need. And this could be something like if they're in their working years, critical illness insurance, disability insurance, even health insurance could be so much more important to them because there's not that safety net. There's no immediate family to catch them when they fall. So having a product in place to do so could be incredibly beneficial. Or even later in life, having a long-term care type product that will pay for someone to come in your home and help you with the activities of daily living, or if you need to go into a facility, whether it's a retirement home or extended care, again, having something there so that you're not depleting your own resources too fast.
So I guess the short answer then is you're not working and you don't have anyone that needs your money afterwards. If you don't have any of those things, then you don't really need insurance.
Yeah, well, think of insurance as the price you pay to not deplete your assets suddenly or unexpectedly. And like if there's someone else in your household, spouse or children that you have to consider, you do have to figure that in as well. You have to think about the impact to them too. But if you think about it as the price you pay to not deplete your assets, that's basically putting value on the work that you've done so far to get to the point that you are today. And like I said, there's all different kinds of products out there. So there's all different kinds of things. There's even products out there that will protect your ability to save, that'll put money into a retirement plan for you if XYZ condition is met. So it's kind of funny that the insurance companies have kind of adjusted and allowed for this in the products that they've built. So let's get in really quickly to the different types of insurance. And we're only going to touch on today the ones that we deal with directly because we know them the best.
It's the ones we're licensed to talk about.
Yeah, exactly. Well, and I would say right off the bat, health insurance and dental. So health and dental, a lot of us have this through work and don't really think about it until we get to retirement where we might take a continuance plan or we might have to buy additional coverage for ourselves.
Or one of your kidneys braces.
Or both of your kids need braces, or all of your kids need braces, because that seems to be the way it goes. Well, no, but think about it as if the premium you paid, assuming you're paying it yourself, or even if you have benefits through work, this allows you, when you understand what's available in your plan, to spend more freely on your health. So if you're in good health, that's great. Insurance in this area will be cheap. But the reason we encourage even young people to buy this when you might be in a position where a job change, not all jobs have this type of coverage, once you get a condition, that condition and any medication related to it will not be covered. So buying health insurance, even a super basic plan early, protects that at a base level. And yes, we're in Canada, there are programs that can assist, but that aside, not everything is fully covered, and that's when private insurance, health and dental can step in. So think of health insurance as if you're looking at the money you spend as your investment, the return on investment is I'm now going to go do things I may not otherwise do. I'll go to the dentist, I'll get that massage, I'll go to that extra therapy or whatever is covered in my plan and take advantage of these services because it's something that I'm already paying for.
Yeah. So next on the list would be disability insurance. So this is if you have like an accident at work, you are injured in some way, you have some sort of medical event. And essentially, this is the insurance that's supposed to kick in if you cannot do your day-to-day job anymore. This is more than that 2-week short-term disability you might have at work. This is something that has the potential to pay up until age 65, depending on the specs of your plan.
Well, that's right. And accidents don't necessarily have to occur at work. Most privately held disability plans will cover you 24 hours a day, which is a really important feature. And a lot of group plans that people have typically will only cover the first 2 or 5 years of your regular type job, the duties of. So that's when a private plan can make a big difference to step in to protect what you're skilled at for the remainder of your working career.
Yeah, and this is where we also see some people might have a work plan and they also have a personal plan that'll kick in the day after their work one really runs out. So if you have a 2-year coverage at work, you get a 2-year delay on a personal plan, you've got your continuous coverage.
That sounds to me like good planning. Critical illness is as the name described. If you are diagnosed with, and in most cases, there's a brief survival period like 30 days, there's a lump sum, typically tax-free, that is available to you. A lot of people will plan it either to a debt, to cover a debt, or to a certain number of years of income that they're wanting to cover, or to just give them some options in terms of getting medical care elsewhere.
Yeah, and with CI, this is one, it's important to shop around because different carriers have different events and medical issues that they will and will not cover. Some of them, it could only be like the big 3 or 5. Some of them could have like 20 different things to cover. So this is one where it's really important to kind of go through that contract and see what is actually covered in there and what are their definitions and their timetables.
It's true, because not everything is covered, or there might be exclusions, there might be ratings, premiums might be a little bit more expensive. The contract means everything, so working with a qualified professional is your best solution here. Long-term care insurance, we talked about this a little bit briefly. There's only one carrier left that does this product in Canada, but there are several carriers that will have it as an add-on to an additional existing policy, whether that's critical illness, disability, or life insurance. This is covering the cost of having someone come and help take care of you if you have a change in your mental capacity or ability to take care of yourself. And they look at this in terms of daily activities of living, which is bathing, dressing, toileting, transferring, continence, and feeding. And then finally, life insurance. There's term, temporary insurance, and then there's permanent, forever insurance. Term insurance, temporary insurance, as the name implies, you know when you sign this, it's usually to cover a big debt. It's not forever. Permanent insurance, you think it's forever, but you have to be a little bit tricky. Some of them, you have to be a bit careful because some of them are tricky, not us.
Yeah, and when it comes to like a temporary insurance, this is one you might be familiar with if you have like a mortgage, because a lot of people have a term policy set up to kind of go along with it. The term can be 5, 10, 15, 20, 25 years. Depending on the contract, it could renew, but you got to watch the premium adjustments when it renews, because these are the kind of things that are, they're okay for the initial time period, but they can get expensive pretty quickly, as opposed to a permanent, which is a bit more predictable in the long run.
Yes, but there is a trick to permanent insurance. Some has cost of insurance that does not increase over time. If you're planning to keep your plan forever, that's what you want. If you have anything else where there's like an increasing cost, it could be yearly renewable, it could be something else where there's an increase to your cost as you age, you don't actually have a sustainable plan in a lot of cases. Sometimes there will be cash value, sometimes there will be other features, but if you have one of these plans, if the insurance premium increases over time, take another look at it. Make sure that it will do what you think it will do, and make sure if this was sold to you a long time ago and there was illustrations involved that might have higher interest rates than what things are currently in this interest rate environment, that needs to be reviewed as well.
Yeah, and a bonus tip, under no circumstance should you get a yearly renewable term.
Well, yeah, I mean, it's cheap when you're young, but like I said, it's not a long-term permanent solution. As you age, you want to be making sure that you're in a product that you know exactly what it's going to cost and you know exactly what it's going to do and when it's going to pay.
Yeah, so you can get these permanent products either as a universal life, which really isn't used a lot anymore. Segregated funds kind of filled the gap with that. Then you got a whole life, which is another permanent ones. Some of the better ones will have like whole life par, which the carrier will take some of the profits and put it into your account. Or you can have like a very, very stripped down term 100, even though it's called term, it's technically a permanent plan. There's just no cash account, ACB, and some, the other bells and whistles. You get a whole life policy.
Yeah, and there's products specifically for business owners as well that can cover off some business overhead risk, key person risk, things like that that are specific to corporations. So I wanted to transition now into a bit of a story that I came across, and it was such a beautiful analogy that fits in here so well. This is from Daryl Diamond's book, Buying Time. And Daryl Diamond was an advisor. Maybe he still is. I'm actually not sure. He also did training in our industry as well. And his analogy, which is brilliant, is this. So think of this, picture this. You and your spouse are on a 2-week vacation, but you're on a budget. So when do you spend your money? Let's say in the first week, you limit your spending in anticipation of the rest of the vacation. But in that second week, the weather is bad, or your spouse gets sick, and you end up going home with money not spent. So this is a pretty obvious analogy. This is actually about retirement planning, where most people, their best years are that first 10 or 15 years of retirement, where they're going to want a little bit extra cash flow, but not having proper insurance in place can cause some people to be hesitant to spend because they're worried about what may happen in the future. And this is where the proper plan can fill these risks, cover these risks so that that stress is gone and they can now spend through the best part of their vacation, through those best 10 years or best 15 years of their retirement. So if you have a fear of running out of money, or if you have a fear around health changes or associated costs, these are where insurance will come in. Like the health change, long-term care speaks to that exactly. Or even if you've had a parent or seen someone near to you that has gone through this or had to act as a power of attorney, this can make you really understand on a material level what this product can actually do for you. If you're someone that wants to leave something behind and you don't want to spend all your money because leaving a legacy is very important to you, you have that deep desire to set things up for the next generation financially, this could be where permanent insurance makes so much sense. And there's a quote in here that says, "Why are we so hesitant to insure something that is a sure thing? We all have 100% chance of dying one day. And hopefully it doesn't occur until a very distant point of time in the future."
Yeah, and another way we've seen life insurance being used is to kind of equalize inheritance between different siblings. Like we've seen cases where one sibling will live in the same city as the parents, the other one will live across the country. So the one that lives with the parents will get the house, but then they'll use insurance to give the value of another house to one outside the province. So these are the kind of things you can use to equalize things between the kids too.
Yeah, so really across all life stages, there's a need. So when you're younger, most people are looking at term insurance during their working years to cover off both debts that they might incur, like their mortgages or car loans, or even just looking at the value of the cash flow that they will generate during their working careers and turning that into a lump sum that could be invested for their spouse to continue the standard of living. Someone in their working career would look at that health insurance, disability, critical insurance, where, like we said, in retirement, the needs change. And long-term planning, taking care of yourself, making sure there's provision, and number one, that those assets don't deplete, that we've offloaded some of that risk. And not just that, given ourselves access to a pool of capital that we didn't have to save for. We just paid a premium in the event that it would happen, is something that can be a very powerful tool to manage our own understanding and expectations about how our money will be spent. So I think that this is very, very valuable information today. Life insurance is not people's favorite topic, but it is one that truly life can be so much better if something bad has happened and we have this here to support us. So make sure if you're buying a product today, talk to someone who's qualified. Talk to someone that's been in the industry for a while, that specializes in this area, that represents more than one insurance provider, and that has proven to you that they have your best interest in mind. They're not just trying to do a quick sale. And you can tell when someone takes time to go through your budget and your cash flow to truly evaluate your objectives and your net worth and where the holes might be in your group plans. That's the kind of person that's putting in the work to help you find the right fit.
Yeah, this is why we're up to 13 different carriers we represent now, because some are better for permanent, some are better for term, some are better for DI, some are better for CI. So there is that wide range and different ones specialized. So try and find someone that can actually offer you kind of the wide gambit of what's out there, and you don't just walk into someone's office and they offer you one carrier and one solution. That is not what could be best for you.
Absolutely. And before you leave their office, make sure you understand what you've bought. It is so crucial that you fully understand the ins and outs, the what, the when, the why of your plan. When will it pay out? How much is it going to cost me? Is this going to change over time? Will this be there for me at my time of need? What are the criteria around whether a claim will or will not be paid? Some policies, especially ones that are a little easier to get, might have some very, very firm exclusions written right into the contract. So some things are immediately right off the table. Insurance is very much a you get what you pay for game. So understanding what you need and what you want and how your product fits is the most important thing you can do. You're not alone in the research. That's where your advisor can help, but please make sure that you take the ownership of the product that you're buying and fully understand how it benefits you and your family. So that's how we saw insurance today.
The entire insurance industry in 30 minutes.
I know, right? Very, very valuable products. They've changed our life dramatically. I recommend this to everyone as a first step. So if you're in BC, Alberta, Ontario, Manitoba, Saskatchewan, or the Yukon, find us. This is the beginning steps of our plan. We'll look at your budget. We'll look at your existing insurance, what your needs are, what your group plan is, poke holes in everything, and make sure that you're covered in the event that something goes wrong. Because having that safety net for that rainy day is the most valuable thing that you can do today. So until next time, take care of yourself,
and all the best.